How's it going, everybody? My name's Ian Sanders with Oasis Financial Services. Today, I'm just going to be going through the different types of insurance and giving just examples of what each one is used for. So, we're talking about term life insurance, whole life insurance, index universal life, final expense, and mortgage protection. Reason that I wanted to go through this and not just talk about what they are, but how they should be used is because there's a lot of confusion out there today. There's a lot of agents pushing different things. A lot of it is commission based and it's not based on what the client's needs actually are. So if you're looking for insurance, you want to go with a broker or with an agent that is going to ask you questions to figure out exactly what it is that you're looking for. That they actually put together a plan that's going to fit your needs and not just something that they're told, by their uplines or bosses or managers or whoever the case may be to push that particular product. Now, the first one we're going to start off with is term life insurance. A lot of people know it. A lot of people have it. It's really cheap. The reason for that is it expires over time. So usually you'll see these in 10, 15, 20, and 30-year terms, meaning that after that time frame, it's going to end. Now, the problem with that is if your insurance ends and you still need insurance, you're in a lot of trouble if you've had some kind of illness or something and become insurable. So let's say, for instance, I have a 30-year term. I'm 40 right now. I get cancer, and now at 70, I'm still alive. I still need insurance. I won't be able to get that again, depending on the type of insurance and how long ago it was from the time where it terminates. So that being the case, term life insurance is not a good fit if it's going to be something that you need long term. Now, you may hear people say like you can buy term and then invest the rest, and down the road you're going to be able to self-insure, but that doesn't happen most of the time. That's a very Mickey Mouse Disneyland type of pie in the sky mentality on it. In reality, it's very real that you're going to pass away at some point in time. And so you want to have something in place that's permanent, something that's not going to go up in cost, something that you're not going to have to worry about renewing again down the road. And term life just doesn't fit those characteristics. Now, it is useful in certain circumstances. So I brought up mortgage protection before. Basically, mortgage protection a lot of times is term life insurance, and the only reason that they're using it is just to cover the mortgage while they're still paying on it. Make sure that their loved ones don't have to worry about the cost or end up, on the streets or having to sell the home if something were to happen, that it's taken care of. Very responsible thing to do if you already have something permanent in place, because at the end of that term, you're probably going to need insurance. And I've actually worked with families in the past where that was my exact question, like, hey, after you pay off the home, are you still going to need insurance? And if the answer was yes and they didn't have something in place, we went ahead and went with something more permanent. Now, with whole life insurance, that's been around the longest. With whole life insurance, it is permanent insurance. It does normally have living benefits, meaning if you get seriously sick, seriously injured, you can pull from the death benefit in advance. It's not really designed specifically for that, but it does have. So, what it does is it has cash value that accumulates over time. It is a lot more reliable, especially if you go with a mutually owned whole life company, because instead of it going to stockholders, what they do is they share the profits with those that have policies. So you do have a pretty reliable growth over time, even if it's not as great as index universal life, which we'll get into in a minute. But you also have paid up options and things like that too, where basically you can stop paying on your life insurance and get to keep that policy. It's also great for seniors too, because a lot of times if you've had some health issues in the past, that'll be the only thing that you're going to be able to afford and that you're going to be able to qualify for. So if you're in your 60s, you're in your 70s, whole life is probably what you're going to go with. If you're in great health, never had anything happen, and you want those larger policies, then you can still get whole life, but IULs are also another option. Now, with IULs, the thing about those is right now, everybody is trying to sell IULs. A lot of times they come from simplified issue type things, and IULs are not simple by any means. Typically, what you would want an IUL for is if you're looking to make sure that you have permanent insurance, so you're not going to have to qualify for it again. You want to get some cash value because it does grow with the market without losing money, which is great. And then you really want living benefits because they tend to have the best living benefits as far as, if you're terminally ill, given 1 to 2 years to live, You can pull most of the money out at that point. You can also do that if you have something like cancer. Recently, during the pandemic, they were paying out if you were to get COVID and were hospitalized. So they have really good benefits there. But a lot of times they're sold as a retirement plan, and they are not that. They are good though for emergency fund purposes. So if you're having trouble saving for your emergency fund, what you can do is pay extra into the policy. That'll go into the cash value. It'll grow faster than putting it into a bank. And then if something serious happens, you can pull that money out or borrow against it so that you don't have to pay taxes on growth and things like that. But I'll cover all of that in another video specifically for IULs. There is a lot to it. Now, the next one, we covered final expense a little bit. That's just going to be a whole life policy designed for seniors. And then again, the mortgage protection is going to be more term life that's designed specifically to fall in line more or less with your mortgage. There are a few different ways that you can do it. Some give cash back where after you pay for your insurance policy for 15, 20, or 30 years, if you don't pass away, they give you your premiums back. You can use that to help pay off your mortgage. But typically, if you own a home and you don't have insurance already, you're going to want something that's going to cover the home and then still be able to leave money for your loved ones down the road. Because if you're, let's say 30, you're on a 30-year mortgage, continue paying on that policy until you're 60. A lot of times, if you're using either a whole life or an IUL policy, you can stop paying at that point. You still do have enough cash value in there to keep the policy going. And you have a death benefit that's high enough where now you can leave that money for your kids, and then you still have your home completely paid off at that time as well. So hopefully this was helpful. If you do like the video, you can subscribe, click the notification bell. Also, there's going to be a link down in the comment section below where you can schedule a time to speak with me directly, completely free of charge. You don't have to worry about anything like that. And I can answer any questions you have. Hope everybody has a great rest of their day and has a fantastic weekend.